Since it has been a general notion now that finance is the health of every business, and it is the nutrient that every business needs to flourish. Let me welcome you to our section today titled Financial Statement Analysis. Uh, you will be wondering, why this class is important to you. Like you will see at the top head, we call it Dear CEO and Business Owners. It is important for CEOs and business owners and finance related persons or people who are into business in one way or the other to know what is contained in the financial data. And that is why we are bringing this class to you today. All right. So, dear CEO, are you making the right profit? Now I'm going to open up some things to you that will make you to know whether you're making the right profit or not. Underline the word right, the right profit. Now, you may be thinking you're making profit, but you may be making the wrong profit. You understand it? Because it's possible you make wrong profit. All right, and this is what we're going to be exposing us to in this section. What do you know about your finances, apart from your signature and your executive chair? A number of CEOs don't even know what is going on in their financial data. You understand it, and that is why it's important to pay attention to us today while we take you through the items step by step that will make you to have an eye opener, have a revolution of your finances as a business owner or as chief executive. We want to explain your business finances through our masterclass on financial statement analysis. All right, meet me. This is James Ayodeji, yours sincerely, a chartered accountant and associate member of Chartered Management Accountants. Okay, we've been into this for a while now, in the accounting industry for a while, and God is helping us. Yours sincerely is a case study lecturer in a number of icon centers, and so on and so forth. You can just read about me. If you click the website below, you will be able to read more about your humble masterclass teacher on financial statement analysis. Okay, let's go on. The preliminaries. Research has shown, like I said earlier, that only about 5% of businesses survive the first 5 years. How is that correct? This is because the key factors to business failures is the fact that many business owners do not manage their financial data very well. They don't manage their financial data very well, number one. Number two, probably a number of business owners leave their financial analysis or in the hand of a third party. Absolutely. Now, there is nothing wrong in getting consultant. There is nothing wrong in getting accountant. There is nothing wrong in getting someone to do something for you. But it's ideal you have an idea of what the person is saying. In fact, if you don't have an idea, there are some terms that you'll be hearing from those professionals, including yours sincerely, that you won't be able to relate with them. So it's ideal you pay attention to a masterclass like this so that you will be able to relate with henceforth whoever wants to tell you or talk to you about your finances. However, you will even know more. You will know more. You will understand it more, and that is why it's important to pay attention to this class. All right. Now, the next thing is, why is it necessary for CEOs to possess basic financial skills? Number one, decision making. If you want to make decision, you have to make what we call an informed decision. You have to be informed. If not, you will be deformed. And if you do not make in now, remember the analyst has said that the duty of or the role of a CEO is 80% intellectual and 20% maybe like physical. You have to be making decisions every now and then for your business to flourish. And remember, I said that finance is the health of every business. So if your health is not well, if you are not informed about your health, you won't be able to take informed decision also on what next to do in the business. You understand it? Okay, so that is number one, very critical point there, decision making. Number two, for forecasting. Yes, it will. If you have an idea of what is going on in your financial data, it will help you to have what is called a conceptual skill. It will help you to build on the planning, your budget. It will help you to review your budget from time to time. It will help you to make right decision and do a forecast and do a strategic planning on your finances, which will simultaneously like yield positive results on your business. I hope this is flowing to us. The next point here is dependability of record. Now, if the foundation is destroyed, they say, what shall the righteous do? Now, this is it. If for your finances to be as dependable, you must have a good idea of how the composition is being made. For your financials to be dependable, and remember, it is whatever on your in your finances, on your paper or on your system or on your Excel that you will be taking decision on. Remember, so you have to ensure that these figures are correct. Remember, I told you in my previous slide that you must be able to know whether you're making the right profit or not. Many businesses are making wrong profit and they thought they are making right profit. In fact, let me put it in a straight way. Many businesses thought they are making profits now. If you check them very well, they are not actually making profits. And that is why many businesses die within the first 5 years, like we said earlier on. You understand it? This is because they lack the understanding of what we are saying in this class today. All right. So dependability of your record is key to you, and that is why you must be able to let your your understanding in finance be up to date, be top notch. At least have a good understanding of what your financial statement is saying. Have a good understanding of what your financial statement is saying. Effectiveness of operational instruction. Effectiveness of operational instruction. This is another reason why you have to ensure that you understand what is going on in your financial arena or in the financial arena of your business. You understand it? All right, let's move on. We are now into the business of the day. The business of the day, which is exposing us to what are the data that are composed in your financial statement, or how will you even interpret it? How will you translate it? How will you translate the things that are composed in your financial statement as CEO, as business owner, or as a business person, so to say? We are going to expose you now into all this. So sit properly, calm down, and pay attention. Please do not hesitate to ask us questions. Do not hesitate to ask us questions on any area that you don't seem to understand, because that's the purpose of bringing up this master class. I hope it is clear to us. All right, before we go on, or before, let me put it this way, that before you engage us to come and clean up your books, to come and restructure your books, is ideal will let you have an idea of how your book should be put together. Follow me. Statement of profit or loss account. Statement of profit or loss account. Friends, this is the first thing that you will be seeing in your financial statement. Statement of profit or loss account. And what does it mean? This is the statement that shows the operational performance of an entity. Your operation per time is being recorded in this account, in this set of accounts. Your operation per time, and that is why it is called profit or loss. It shows you whether you're making profit or you're making loss, because every business is created for the purpose of making profit, So if your purpose is to make profit, then you must pay attention to the things that will make you to know whether you're making profit or you're making loss, or you're making the right profit. I love saying that because I've gone through the books of many businesses, and I've seen that a number of times that we felt like we are making profit, we are not actually making the right profit. Probably, okay, we're going to be talking that. Don't let me move too fast. We're going to be talking that on the rest later on. Now, we're going to be looking at next the compositions of this statement of profit or loss account. Look at, I brought an example here. Here's a fill out table for the statement of profit with example amounts in US dollar. Now, you will see clearly on your screen now statement that is showing for two companies. The statement that is showing for two companies. We have ABC profit scenario and we have XYZ limited scenario. All right, let's just look at the items. We have revenue, you less cost of sales. Now, gross profit. Now, friends, please pay attention. I am still going to tell us each of the components. I'm still going to let us know each of the components, what it means, how you're going to pull them together. I'm still going to let us know. So this is just a summary of how an ideal statement of profit or loss account is being shown or done. You understand it? All right. So please, if you have any question, do not hesitate to chat me up or just send me. I will answer you immediately. This is a live show. I will answer you immediately. All right. So I started by putting revenue here, and I put less cost of sales. If you less cost of sales, it will give you your gross profit. Then from your gross profit, you are going to less your admin expenses, and you are going to less your distribution expenses. It will give you your operating profit. We call it operating profit because there might still be one or two things that you will need to still add or less so that you can get your net profit. Okay, and you call them other expenses. You understand it? You call them other expenses. Okay. Sorry, before you go there. Okay, so other expenses, then you had other income, then you less you'd add other income, then you less other expenses also. So with that, you will be having profit or loss before tax. Now, this is just a simplified form. In an ideal form or in a professional manner, you'll be having something like profit before interest and tax. You understand it? Profit before interest and tax, and then from there you will less your interest. Then you'll be having profit before tax. Then from there you compute your tax and you take it away from that, from the figure you got before, you will now be having profit after tax. But that is professional language. For this class, we are having profit before tax, and you less your taxes. From having less your taxes, you will be expected to have your net profit or your net loss. All right, please pay attention to the figures. You can go through the figures. If you have any scenario about it, you let us know. Please just chat me up. We are here to solve any problem that you be having as it relates with financial statement analysis. Financial statement analysis. All right, we did not stop there. We put it on the chart so that you would, on the diagram, you will be seeing how the movement of all these things. You understand it? All right. The next thing is, what are the items that are found, like you have seen, like I showed you in the last two slides? An ideal income statement, or what you call statement of profit or loss account, contains, number one, it contains your revenue. Now, remember what I said earlier, friends, that for you to say you're making profit, you must be able to make the right profit. You must be able to make the right profit. And how do you make the right profit? It is starting from putting the right thing in the right place and putting the right figure under the right section. For example, revenue. If you don't understand what revenue is, you may not be able to get the right profit. All right. So I define your revenue here as total inflow from the entity's core business. Underline the word core business activities. Note, the inflow must be generated from your ordinary course of business. Any inflow that you generate that beyond the ordinary course of business is related as other income, not revenue. I hope you are following. Not revenue. All right. And what are the key points to note? Before I move on, you will be seeing on the right hand side of your screen, bottom right hand side, there is a video that we did that have been done on revenue recognition. How do you recognize your revenue? Because you're not going to be getting everything right on in this class. Of course, this is just a first section. There will be other sections, and then for you to know detail on each of these topics, we have done videos that concerns each of these topics, so that for you to go and relate with, then it will give you full understanding. You understand it? Okay. Now, what are the key points to knowing the right revenue amount? Underline the word knowing the right revenue amount, because a number of companies or CEOs or business owners record all inflows as revenue. No, it's not correct. Not all inflow, not everything that came into your account should be classified as revenue. And that is why we are bringing this up. What are the keynotes? It must be an inflow from the entity's normal operation. If you are selling cars, your inflow will be when a car is being sold. Your revenue will be when a car is being sold. That is a revenue and it must be within a particular time frame. All right. Number two, it must be for the operations within the year. Like I said, within a particular time frame. Whatever happens from January 1st to December 31st on the business we are doing, our core operation, whatever sales we're able to make, whatever we're able to generate through the sale or through the exchange of whatever we are giving out, either services or products, you understand it, it should be referred to as what? Revenue. All right. Oh, here, I think we are not here yet. All right. So, not all inflows are your revenue. I've said that earlier. The purpose of collecting the revenue must have been satisfied. Now, this is another one, especially for firms that are in the construction company or real estate. Please take note. Construction firms, real estate firms, supply chains. You must note this point, that the purpose of collecting the revenue must have been satisfied before you can recognize it as your what? Revenue. And that is why it's important for you to go through this link that is attached to this section. There is a link that is attached to this section Please go through it. It will show you how revenue should be correctly recognized. Is that clear? All right, let's move on. The next item in your uh, statement of profit or loss account is cost of sales. Cost of sales. Now, your cost of sales is a direct cost associated with the revenue. Now, you know revenue is, we just said that, is the exchange of what came in through our normal course of business. Now, the whatever you are giving out did not or does not just appear. You use money to buy that thing, or you use money to create that thing. Is that correct? All right. That now means that whatever money you use to create or to buy what you are giving out to generate your revenue is what we're referring to here as the direct cost associated with the revenue. Exactly. Okay. Now, cost of material is one of them. Is one of the cost of materials. Then the cost of, let's say, purchases is one of them. The carriage inwards, the amount it costs you to bring those things into your firm or into your warehouse, is part of your direct cost. All right, etc. The cost of sales must be deducted, therefore, from the total revenue to give you your gross profit. All right, the next thing is what we're going to be talking about, which is gross profit. This is called gross profit because other items of indirect cost had not been taken care of. All right, I hope this is clear. It's gross because other items of indirect costs. Remember, we just showed us what direct costs are. Now there are other costs called indirect costs. You must take them away from your gross profit to get the right profit that we're talking about. Now, items of indirect costs include, number one, administrative expenses. And this include, of course, you will have staff that you are paying salary. Their salary form part of these admin expenses. Rent form part of the admin expenses. Advertisement form part of the admin expenses. Utility bills, repairs and maintenance of office materials, etc., are some of the items under administrative expenses. Let's move on. Distribution is another item under your indirect expenses, indirect costs. And distribution entails everything that it will cost you to move your item from your warehouse or from your office to your client's abode or your client office or your client doorstep. You understand it? Okay, that is what we refer to. Everything should be put together and classified as distribution expenses. I hope you're following. Please, if you have any question, please feel free to let us know quickly and we'll attend to it. All right. All right. The next thing is your other expenses. Like we said, it depends on the nature of the business you're doing. So there might be other expenses that you are spending. You understand it? You classify them here. Any expenses that you are spending that does not form a part of what we just highlighted now, your cost of sales is not part of your admin expenses and is not part of your distribution expenses, then it should form part of your other expenses. I hope this is clear. All right, so let's move on. Statement of financial position. Remember, the one we just finished now is statement of profit or loss, and we said that talks about, or it shows you how your operation fared within a particular period of time. You understand it? Now, again, we have done a video on statement of financial position. Please do well to go through this video so that a clearer understanding will be gotten from that video, in addition to whatever we're going to explain here in this class. How that is clear. So this is another part, another section. Before I go on, I must let you know that your financial statement has 5 components. The first one was the one we just finished talking about, which is statement of profit or loss account. The second one is statement of financial position. The third one is could be statement of cash flow, then statement of changes in equity, then you have note to the account. Now we are in the second leg now, which is statement of financial position. If you need us to come around and or if you need our assistance to help you choose your record, this is an opportunity for you. You can just let us know. You can chat us up. We will do justice to just that. Or you are having issues in keeping accurate record, or you are having issues in keeping correct accounts, or you are having issues in having a computation of your revenue or your cost, or how to minimize cost and increase profit, etc. We are here for you. Just chat us up and we will pay attention, we'll do justice to just that. Again, dear CEO, I present to you the second leg, which is statement of financial position. All right, the SFP is otherwise called balance sheet. Is otherwise called your balance sheet, and your balance sheet shows how your business is faring in terms of asset. I'll still show you that in our next slide. You understand it? In terms of asset, and in terms of your liabilities, and in terms of your equity. All right. So basically, statement of financial position is divided into 5 major segments, and you will be seeing them. As you are seeing them on your screen now, which is non-current asset is the first one. The second one is current asset. The next one is non-current liability. The next one is current liabilities, and the last one is equity. Now, you will be seeing the items that are contained in each of these. They are not limited to this, friends. They are not limited to this. There are still more. We only brought this around. So for you to know more, please refer to this link. Go to this video, watch it, and trust me, you will have a good knowledge on what we refer to as statement of financial position. All right, let's move to the next slide. Dear CEO, what are the importance? Why is it necessary that you even pay attention to this statement of financial position? Why is it necessary? It is very, 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 very critical. For example, if you want to go into investment, if you want to partner with any business, you must check their financial position. And as the word implies, it is the position that their financial statement is carrying. It is the position, what position are they? Are they in debt? Are they not in debt? Or do they have enough equity versus their debt? I will even show us now let's go through these slides together. He said this statement shows the summary of the entity's total assets. Everything you have is being represented on the side of the asset section of the statement of financial position. Everything you have in terms of your vehicles, your building, your plant and machineries, your features and fittings, the table you are using in the office, the table you're using in your branches, everything is being summed together and is being taken as non-current asset. Okay, like I said earlier, part of the asset is still also the current asset. The current asset is, maybe I should go back to that slide. The current asset shows the items that are convertible within the year to liquid cash. Items that are convertible within the year, that it is easier for you to bring them back to cash easily, to raw cash within the year. They are the things we refer to as what? As the current asset. Okay, let's just move on. Now, I'm continuing from, it also measures the performance of the entity's debt versus the corresponding equity. The performance of the debt versus the equity of the firm. All right, the SFP shows how liquid a company is by going through its current asset and corresponding current liability. For example, if you want to invest in another firm, these are areas that you have to pay attention on. You have to look at it, check, put their current asset on top of their current liability. Can it go twice? Do they have a current asset that can pay their current liability 2 times? If this is not so, then you have to call your finance professional to look at that account again for you. It's important. You understand it? And if you want to assess yourself also, take your financial, check the total of your current asset, put it on top of your current liabilities. Does the liability, does it go in 2 times? Can you have twice of your liability in your current asset? If the answer is no, then you have to pay attention. You have to look at the component of these two classes and how to rejuvenate it quickly using several, a number of strategic decisions. I hope this is clear. If you need more of this strategic decision, please chat us up. We would help you on how to find solutions to some of the problems you might be having in your businesses. Right. The next thing we will be that this slide is telling us is business owners can also compare the relative growth in the entity's debt and equity through year-on-year comparison. You can do year-on-year, you can do month-on-month, you can do department by department, you can do quarter-on-quarter, you can do branch on branch, you can do a lot of comparative tools. All right. In our next section, we shall be letting us know for CEOs, we have several analytical tools that you can use to dissect your financials, so that, because you might be asking that how do I now calculate it and all that, what are the tools that are available? Now we will be letting us know in our next master class, and trust me, you will not want to miss it. All right, going forward, all right, we have statement of cash flow. Statement of cash flow, like I said, this is the third step. Remember, statement of profit or loss account is the first, followed by statement of financial position. Now we are in statement of cash flow. This is essentially this is the movement of money into and out of a business. How does money come in and out? Cash come in and out, and that is why we call it cash flow. Cash flow is the cash flowing outside. Is it flowing inside? What is the rate at which cash moves? The rate at which it went out compared to the rate at which it came in. These are the things that statement of cash flow is talking about. Now, a number of firms are having issues with this statement, with this cash flow, with cash flow. It is the cash flow statement that will make you to know whether you have to review with a keen attention your cash planning or your cash budget. You have to review it, whether you be paying your debtors, whether you should be paying them in a shorter period or in a longer period. It is cash flow statements that will show you that. Okay, whether you should review your investment, whether you should review your finances, etc. It is your cash flow that will show you that. All right, before I go on also, if you want to invest in any firm, this is one of the documents in their financials that you have to look at. You want to do your investment, you want to do your thorough check, you want to do your due diligence in any firm, or you want to partner with any firm, check their cash flow. How healthy are the inflows? How healthy are the outflows? So these are the things you are going to be seeing in the statement of cash flow. All right, now let's come back to the slide. Key components of cash flow. Cash flow, we have the cash inflows, like I said earlier, which is the money that is coming in, sales, investment, loans, other sources. These are inflows. Now we have cash outflows, like I said earlier also, and money going out. This covers expenses like operating cost, debt, repayment, investment, etc. Now we're going to be breaking it down further because there are three major components to a cash flow statement. Three major components, and they are namely as operating cash flow, investing cash flow, and financing cash flow. Operating reflects the cash generated from a business core operations. Now, by now, you must have been hearing this statement: core operation, cost business of the entity, etc. So, the cash that is being generated from this core business of the entity is what we're looking at here. We'll look at both the inflow and the outflow. All right. Now, another part to this operating cash flow is that cash, this shows, or rather, the another fact to the statement of cash flow is that it shows the real cash that went out and the real cash that came in. You know, that is what is called in-pocket expenses, and that is what is called out-of-pocket expenses. There are some expenses that you will be seeing in your financials, for example, in your statement of profit or loss account, that were not actually spent. Example is your depreciation. You will charge depreciation because that is how to expend the asset that you have bought, and how to plan on how to get another one, how to do the wear and tear of the assets. That is why you are charging depreciation. But are you spending that money? The amount you charge on depreciation, is the money going out of your pocket? No, the money is not going out. So all this will be considered in the operating cash flow. I hope you're following. All right. Then in investing cash flow, this involves cash used for investing activities, such as buying or selling assets, property, or equipment. I hope you're following. All right. So uh this is the part of investing cash flow. If you need more detail on this, because like I said, we cannot finish this for the want of time. We cannot just break it down to the lowest particle as it will be expected. You can just chat us up. You can also book a private class with us. Yes, you can book a private class with us. If you are a CEO and you want us to, or have a private chat, please go ahead and do that. We will be glad to pay attention to whatever the challenge of the business is. The last one on the types of cash flow is what is called financing cash flow. Financing. Now, from the word financing, it means how is the firm being financed? How are you financing the firm? How are you financing the firm? And this relates to cash raised from or repaid to investors and creditors. It includes activities like issuing stocks. Issuing stock is one of the ways with which you finance your business. Is that also? All right. Then bonds is one of the way, or paying dividends. Paying dividend, money is going out. When you issue stock, money comes in. Is that also? All right. So these are the activities that shows that will be classified under your financing cash flow. Remember that statement of cash flow is a very vital key when, one, you want to invest in another business. Two, you want to assess whether a business is doing well or not. Three, if you want to partner with another entity, check their cash flow statement. It will tell you their health status. It will show you their financial health status. I hope you're following. To show you their financial health status. Remember, the profit that companies are depicting that they get might not exactly be the profit. It is in the statement of cash flow that you will know, that you will check it out, whether they are doing well in terms of even the profit making or not. I hope it's clear. And this is part of why it's a bonus for you to actually be part, that you are a part of this class. All right. So thank you so much. That is on statement of cash flow. I hope you're following. The next one, like we said earlier, this is step 4 now, is the statement that is called statement of changes in equity. Changes in equity. And is a financial statement that shows how a company's equity changed over a specific period. It has to be a specific period. And what is equity? Just say that the capital that the company is using to do business is equity in a layman's language. Though it is beyond that, but in a layman's language, that is the capital that you're using to do your business. A part of your capital could be the money you borrow from bank. Is that not so? A part of your capital could be the shares that we said earlier that you sell to the public to raise money. A part of the capital could be the loan notes you're selling to the public to raise money. Is that not so? A part of your capital could be the money that say that you borrowed from friends, etc. So that is what a cumulative summary of equity. Now let's look at this together. Say beginning equity. Now this statement will show you the opening balance of your equity, what you brought from last year. You will see it there. So whenever you're looking at any firm, or you want to partner with any firm, or you want to invest in any company, you have to look at it critically. Look at their statement of changes in equity. What was their equity in the last year? What happened within the year to their equity? Did they dilute their share? Did they sell more shares? Did they pay dividends within the year? And or did they borrow more money? Or what happened? What was their retained earning at the beginning of the year? What was their retained earning at the end of the year? You know, like I said, retained earning also is one of the terms that you'll be hearing, and we have a video also on that. You understand it? That you can use to actually understand well how to manage your retained earnings as a business owner. How to manage your retained earnings. So it's part of the item that you've seen, and the profit also is part of the items you'll be seeing in the statement of changes in equity. All right. So net income is there, which is the profit that I said earlier. Your dividend, the dividend you paid, the changes in the dividend. For example, if a company that you want to partner with pay dividend of say 5 naira in the last the last 3 years, in last 2 years they paid 10 naira, and last year they paid about 46 naira. You know, it shows geometric movement, a progressive movement of increase, you know, progressive increase in the payment of dividend. And it tells you that, okay, if I invest in this company now, there is every likelihood, that is a projection anyway, that I'm going to be getting more dividends even in the forthcoming year. Or if you want to partner with such a company, you are sure of having a robust profit, because it is from the profit that you pay dividends. Is that not so? All right, etc. So these are some of the things you will be seeing in your statement of changes in equity. Finally, you will be seeing the closing balance. No, so all the changes will lead you to the closing balance of their equity, and it shows clearly the movement. That is why they call it changes in equity. Changes in equity. That is, changes in the formation of the capital that the company is using to do the business. All right. Let's go on to the purpose of the statement. Reconciliation is one of the purposes. You understand? It reconciles the beginning and the ending of the equity. You understand? All right. Transparency is one of the reasons. It provides the transparency into how equity change over time. You don't just tell us that you have you have what's it called, $15 million as your equity in the last year, and this year you are telling us that it has changed to $25 million. How? It is this statement that will show us how the equity changed or moved from $15 million, for example, to $25 million. All right. Now, the next one is investor information. Now, it helps investors understand the changes in shareholders' equity. For example, investors like shareholders, like bondholders, etc., they will know what happened, how it moved. It's not only their shares that it's not one person's share. So each person will now pay attention on what happened, how did this thing change? Okay, this is how it changed. Is it okay for me? Yes, fine. I'll put more money. Or if it's not okay for me, I might have to exit. These are all the information investors will be seeing in the statement of changes in equity. The next one is the financial analysis. It is used for financial analysis to analyze the financial, to analyze the earnings per shares, to analyze the different capital based ratios, with which we're going to be telling us. Like I said earlier, we have a number of analytical tools, strategic analytical tools that are acceptable globally, that you can use to analyze your financials, that will make you to know, okay, in this year we did well, last year it's like we did not do well last year, or in this department they are doing well, or in this other department we have to do more. All right, so those are analytical tools, and that's what they call financial analysis and ratio calculations. All right, I hope you are following. If you have questions, please go ahead, let us have your question quickly. All right, let's move on. Note to the account. Now, let me reiterate for the purpose of understandability. One, the first one was statement of profit or loss account. We talked about statement of financial position. We talked about statement of cash flow. We talked about statement of changes in equity, and we are now talking about the last one, but not the least, the disclosure part of the financial statement. We call this the disclosure part, and it is called the note to the account. The note to the account. Note to the account. All right, this is the disclosure part of the statement of account. Since the International Accounting Standard 1 has stipulated how all statements should be prepared on the face value, the note to the account reveals all the associated policies applied in the preparation of the financial statement. Now, the financial statements are being prepared with guiding rules. You must note that, with guiding rules. Now, it is in this note to the account that you will be seeing the rules that led to the figures you were seeing in other four components that we mentioned earlier. That the figures you'll be seeing in the statement of profit or loss account, the figures you'll be seeing in your statement of financial position, the figures you'll be seeing in your statement of cash flow, the figures you'll be seeing in the statement of changes in equity, they are all revealed in the notes to the account. I hope you understand that. All right, so that is that. Note to the account could also be referred to as the explanatory information. It is the explanatory information. It tells us more about the information that are contained in the financial statement. It talks about the policies. It talks about the guidelines. It talks about the clarifications. It talks about the supporting data. For example, if you see revenue, what are the things that made up the revenue figure that you were seeing in your statement of profit or loss account? It will be revealed in the note to the account. I hope it's clear. I hope you're following. All right. So that is that on the note to the account. I hope you're getting it. Please, if you have any information or any question, feel free to chat us up. All right. Note to the account also, think of them as the footnote to a financial report. While the financial statement provides a snapshot of a company's financial health, the notes offer the context and details needed to fully understand that picture. The detail you need to understand the picture that is good that they have given you in all these other components, the note to the account will show you. I hope this is clear. All right. Importance of note to the account. You can see how important it is. We have to give more slides on note to the account. Number one, disclosure of accounting policies. Number two, clarification of figures. Number three, additional information. Number four, other additional information like disclosure, and so on and so forth. All right. What are the content? What are the content, typical content of note to the account? Dear CEOs, what are the typical content to the note to the account? The specific content of the note will vary depending on the company and industry, but they generally include number one, summary of significant accounting policies. The accounting policies, like I said earlier, will be shown in the notes to the account. Okay, the next one is disclosure about specific items. Disclosure about specific items. Now, there is a concept called materiality. You understand it? So the material ones, it will show the items, the disclosure about those items. All right, the contingent liabilities. Now, this is important. We're still going to do a section for us to understand what contingent liability is. But for the sake of this section, let's tell us that these are potential obligations that may arise in the future. Potential obligations that may arise in the future. For example, if towards the end of last year, when you have prepared your statement of account, your financial statement, there is a litigation that is germane or that is material enough to affect the decision makers or whoever is using your financial statement, it must be reviewed in the notes to the account under what is called contingent liabilities. All right, related party transaction. Are there parties that are related, entities that are related? Is it that do you do transaction with your branch within the year? Do you do transaction with your sister company? Do you do transaction with people of influence, significant influence over the company? You let us know in the note to the account. Another one is segment information. Now, it shows segment by segment information of the organization. You understand it? Financial data for different operating segments of the company. That is note to the account. It shows it. All right. The next one is geographical information. It shows the breakdown of revenue and assets by geographic location. You understand it? All right. The next one is financial instrument. Information about financial assets and liabilities, including their nature and risk exposure. All this will be shown. You know why it has to be shown? It has to be shown so that decision makers will go through it, see it, and know that there is probably this is the level of risk that is attached to this asset that we want to buy. This is the level of risk that is attached to the liability. This is the volume of liabilities that these people are having, etc. All right, so that is that on that to them. Okay, the next one is pension plans. Details about pension plan will be shown. Subsequent events. Are there other events that are in the future that are material enough for the decision makers to know? You have to show us also. All right. Revenue recognition. I mentioned this. I only brought this around as a teaser for all of us to pay attention so that you can go to that link. Go to that link. There is a video that has been done. Dear CEOs, business owners, you need to know how to recognize revenue. This will be the yardstick to check whether you're getting the right profit or not. It is through your revenue recognition that will make you to know whether you're getting the right profit or not. Hope you're following. All right, so this is a solution that we of problem we sent to the platform, and this is a graph that represents it. Revenue recognition is very important. CEOs, is very important to know how revenue is being recognized. All right, now let's move forward. Dear CEO, business owners, this is our conclusion. In conclusion, understanding financial statements such as the statement of profit or loss account, statement of financial position, and statement of cash flow is essential for business success. These statements offer insight into a company's performance and financial health, like I said earlier, enabling informed decision making, accurate revenue recognition, as illustrated by the example of ABC Limited and XYZ Limited, is crucial for assessing true profitability. Now, remember, I talked about making the right profit is so important, so important. Additionally, the detailed notes to accounts provide necessary note to the account, provide necessary context for interpreting financial statements, enhancing transparency and informed decision making. By mastering these financial principles, business leaders can better navigate, and that is what we need you to take home today. Navigate financial complexities and ensure their company's sustained growth and success. And success. You get. Thank you very much for your attention. And if you have any question, please feel free. Let me have it on the chat box, or you can link me up on WhatsApp on the number below that you're seeing on the screen, or you can just make sure you subscribe to our channel. Make sure you like or and share this video for others to see. We will be glad to hear from you soonest. All right, please, any question, please, let's have you have question. All right, thank you everyone. It's a pleasure being around. One more time, my name is James Ayodeji. I'm your coach in this class. I appreciate you. See you.